I'm Bill Wilt of Assured Research. Thanks so much for joining this quick hit video where we're going to focus on one research note, one topic drawn from our July 2024 Assured briefing. If you're a subscriber to our work, thank you. Thanks to your company, and we hope you continue to find value and enjoy the work. If you're not a subscriber, please feel free to poke around this YouTube website or monitor our LinkedIn, and we'd be happy to start you on a trial to our work if you're interested. We're going to talk about the E&S property markets and specifically vacant office buildings in this note. So let me share my screen and we will jump right into it. Okay, good. You should be seeing it. So incredible growth in the E&S property space. All professionals are probably broadly aware of that, but the numbers are really quite stark. 7 billion, get my numbers right here, 7.5 billion in E&S property premiums in 2018 have grown at an incredible 27% CAGR over the last 5 years and are now 25 billion. So while it seems unlikely that that same pace of growth could continue, still begs the question, given that there are high growth rates expected, higher than long-term average growth rates expected in the E&S space, what could fuel that growth? Well, on the property side, we've been thinking for some time that one of the answers to that question could be vacant office buildings. We're all broadly aware that with hybrid work, office space isn't being utilized fully, at least not compared to pre-pandemic levels. And if you look at the bottom part of this page, this slide, you look at that line, the office vacancy rate is just under 20%, or pardon me, it was at the first quarter of 2024. That was only higher in, I believe, 1986 and 1991. So we're at a kind of a generational high in office vacancy rate, and it's forecasted to go higher by most sources that we look at and what we cite in the research note, and that'll materialize in the years immediately ahead. So why is that relevant? Well, vacant offices, you can easily imagine, present unique risks to the property. Lack of investment, lack of people on site, the risk of higher perils, kind of compound when an office becomes vacant, and policy provisions and triggers and admitted policies can send those vacant offices into the E&S marketplace. So that's why we're focused on it. We think the worst is yet to come, and that could help to fuel growth in the E&S property markets. Other types of buildings we should mention are broadly okay. Industrial and retail vacancies aren't nearly as problematic as they are potentially in the office building space. So in this research note, we've dug into a lot of different resources. Here we're showing data on the left-hand side, office vacancy rates across 30 major U.S. markets. Look at the variability there. Vacancy rates were very consistent in 2009, 11, 15, 17, and 19, and look at that increase. Not a big increase in the variability so much as there just is an increase in the median and average vacancy rates across major cities. Where are those? How does the pre-pandemic and post-pandemic vacancy rates differ? Well, you can see there the averages. It's increased by about 300 basis points, 3%. It's worst in San Francisco, where you see a really sharp increase in vacancy rates. The relevance of all this and what I can share, because we don't have the time to go into all the depth in the research note, is in the note we map, as we've done here, E&S property premiums of $25 billion by state. We show how that's spread across the United States, and using data from our friends at Verisk and their market stance business unit, we're able to look at non-residential buildings and look at the property premiums there and how it's spread. We even map it a bit further down to the metropolitan statistical area level in our research note. So With that, let me just say we're watching this trend. We think the increasing rise in vacant office buildings could help to fuel E&S property premiums, and the research note we think does a pretty good and interesting job of intersecting insurance data with data from outside of the insurance industry, which is one of the things we like to do here at Assured Research. So we hope you found that quick hit video of interest. There's certainly more in the research note, and we'd encourage you to reach out if you'd like to learn more. Thanks so much for watching.